Here is a question I want you to actually stop and think about for a second. When you hear the phrase tax rate, your tax rate, what number comes to mind? 12%? 22? Maybe 24 if you've had a good year? Whatever number you're thinking of right now is almost certainly wrong. And not slightly wrong, dramatically wrong. Because most middle-class Americans are paying far more of their income in taxes than their federal bracket alone would suggest, through a collection of overlapping, often invisible tax mechanisms that the system is not exactly designed to make obvious. I'm not talking about conspiracy theories. I'm talking about documented, legal, structural features of the American tax code that quietly extract wealth from middle-class earners year after year. Mechanisms that most people don't know exist until they're already paying them. And in 2026, several of these traps have become significantly more dangerous than they were even a few years ago. Today, we're going to walk through 5 of these hidden tax mechanisms, what they are, how much they actually cost you, and critically, what you can legally do to minimize or eliminate each one. This is not advice to dodge taxes. It's information about how the system actually works, so that you can make decisions with your eyes open instead of your wallet drained. Let's start with the one that almost nobody talks about, but that hits every single working American, every single paycheck, before they ever see a dollar. Ask most Americans what their tax rate is, and they'll tell you their federal income tax bracket. 22%, 24%. They've looked it up, they sort of understand it, and they think that's the answer. But there's a massive tax that hits your paycheck before the income tax calculation even begins. One that most people dramatically underestimate. It's called FICA, the Federal Insurance Contributions Act tax. You know it better as Social Security and Medicare. And in 2026, this is what it actually costs you. Social Security tax, 6.2% of every dollar you earn, up to $184,500 in wages. Medicare tax, 1.45% of every dollar you earn, with no income cap whatsoever. Combined 765% of your gross income. Taken before you see your paycheck, before your 401k contribution, before anything. And here's the part most people don't fully internalize. Your employer pays a matching 7.5% on top of that. So the total payroll tax burden on your labor is 15.3%. That is the real cost of employing you. And it's a cost that ultimately shapes what your employer can afford to pay you in wages. For a self-employed person, a freelancer, a consultant, a small business owner, it's even more direct. You pay the full 15.3% yourself because you are both the employee and the employer in the eyes of the IRS. On $80,000 in self-employment income, that's $12,240 in FICA taxes alone, before a single dollar of federal income tax is calculated. Now, here's the part that makes this particularly unfair for middle-class earners specifically. The Social Security portion of FICA, the 6.2%, only applies to wages up to $184,000 in 2026. Above that income level, you stop paying Social Security tax for the year. That cap means a person earning $80,000 pays 6.2% on every dollar of their income towards Social Security. A person earning $5 million pays 6.2% on only the first $184,500, a fraction of their total earnings. In practical terms, this creates a system where middle-income earners face a higher effective FICA rate as a percentage of their total income than the very wealthy do. The person earning $60,000 a year pays 7.65% on essentially every dollar they make. The person earning $1 million stops paying Social Security tax in mid-January of the year, according to analysis by the Center for Economic and Policy Research. And perhaps most importantly, FICA taxes don't apply to investment income at all. Dividends, capital gains, interest, rental income, none of it is subject to FICA. This means the wealthier you are, and the more of your income comes from investments rather than wages, the lower your effective FICA burden becomes. Ordinary middle-class Americans, whose income comes almost entirely from wages, pay the highest effective FICA rates in the entire income distribution. The average American household earning $75,000 to $100 in wages pays somewhere between $5,700 and $7,650 per year in employee-side FICA taxes alone. Add the employer match, and the full economic cost of that labor is $11,400 to $15,300. That's not income tax, that's FICA, and most people barely factor it into their understanding of their real tax burden. What you can do if you are a W-2 employee, your FICA options are limited. You pay it. Full stop. But if you have any self-employment income, side income, or own a business, there are structuring strategies that can legally reduce your FICA exposure. Operating as an S corporation, for example, allows you to pay yourself a reasonable salary, which is subject to FICA, while taking additional income as distributions, which are not. This strategy, done correctly with the guidance of a CPA, can save thousands of dollars per year in self-employment taxes. It's a standard legal strategy used by millions of small business owners, and one the middle class vastly underutilizes. The second hidden tax mechanism operates so slowly and so quietly that most people never notice it happening until they sit down and do the math. It has two components that work together, and both of them cost middle-class earners real money every year. Part 1. Bracket creep. Bracket creep is what happens when inflation pushes your nominal income higher, meaning the dollar number on your paycheck goes up, but your real purchasing power stays flat or even declines. In theory, the IRS adjusts tax brackets annually for inflation to prevent, and they do adjust them by approximately 2.7% in 2026, according to the Tax Foundation. But here's the problem. Not all of your financial life adjusts at the same rate, and not all tax thresholds are indexed to inflation. Let's make this concrete. The average American worker received a cost of living raise of somewhere between 3% and 5% over the past year. On paper, they earned more money. In reality, inflation ran at roughly similar or higher rates, meaning their actual purchasing power barely moved, or may have declined. But the IRS sees the higher nominal income. And depending on where that income lands relative to bracket thresholds, that worker may have moved into a higher tax bracket, paying a higher marginal rate on dollars that don't actually buy them anything more than before. The Tax Cuts and Jobs Act of 2017, which was made permanent by the One Big Beautiful Bill Act in July 2025, kept tax rates at their current levels and maintained annual inflation adjustments. That's good news, and it does provide meaningful protection against classic bracket creep for most middle-class filers. For a single filer earning $65,000 with standard deductions and 401k contributions, the 2026 brackets are calibrated to prevent inflationary raises from automatically triggering a higher rate, but the protection is imperfect and incomplete. First, the IRS uses the Chained Consumer Price Index, a measurement that tends to run slightly lower than the standard CPI, which means bracket adjustments systematically lag behind the true cost of living. Second, many state income tax systems do not index their own brackets to inflation. So while federal bracket creep may be partially controlled, your state income tax burden may be quietly growing year after year if you live in a state with a progressive income tax and static brackets. And critically, several of the most impactful tax thresholds in the entire code are not indexed to inflation at all. These are the ones that hit the middle class hardest. And we'll get to two of the most important ones shortly. Part 2. The inflation tax on savings. The second component of the inflation tax mechanism is less about tax brackets and more about the silent destruction of purchasing power in your savings. When inflation runs at 3% annually and your money market account or savings account earns 4%, you're earning a nominal 4% return. But your real return, the increase in actual purchasing power, is only about 1%. And here's what makes this a tax issue. You owe income tax on the full 4% nominal gain, not the 1% real gain, the full 4%. The IRS taxes your nominal interest income, regardless of whether that income represents a genuine increase in purchasing power or simply compensation for inflation eroding your savings. For a middle-class household with $30,000 in a high-yields account earning 4.1% in 2026, that's $1,230 in interest income. In a 22% federal bracket plus state income taxes, that household pays roughly $300 to $400 in taxes on that interest. But if inflation ran at 3% during the same period, the household's real return, the actual increase in purchasing power, is closer to $330. In a bad inflation year, you could theoretically pay tax on a return that barely outpaces inflation, leaving you with a real after-tax return close to zero. This dynamic particularly punishes conservative middle-class savers who are trying to do the right thing. Keeping an emergency fund, saving for a down payment, building a cash reserve. Their reward for responsible financial behavior is a tax bill that partially wipes out their real gains. What you can do, the most powerful tool against the inflation tax on savings, is tax-advantaged accounts. Interest earned inside a Roth IRA grows completely tax-free. Earnings inside a traditional IRA or 401k are tax-deferred, meaning you don't pay tax on the nominal gains until withdrawal. An HSA, health savings account, is the only triple tax-advantaged account in the tax code. Contributions are pre-tax, growth is tax-free, and qualified withdrawals are tax-free. For middle-class earners trying to protect the real purchasing power of their savings, maximizing contributions to these accounts before holding savings in taxable accounts is one of the highest return tax moves available. This is the one that shocks people most when they first discover it, and for good reason. It genuinely feels like it shouldn't exist. Here is the situation. You work your entire career. For every single year you worked, you paid 6.2% of your wages into Social Security. Your employer paid another 6.2%. You paid into this program with money that was already taxed as income for 30, 40, sometimes 50 years. It was not voluntary. You had no choice. And the promise was that when you retired, you would receive those benefits back. Here is what most people don't know. When you actually start collecting Social Security benefits, up to 85% of those benefits can be taxed as ordinary income all over again. You paid into the system with after-tax dollars, and when you collect, you pay tax on the benefit. It is, in every meaningful sense, a double taxation of the same money, and it falls disproportionately on middle-class retirees. Here is exactly how it works. The IRS calculates what they call your combined income, your adjusted gross income, plus any non-taxable interest, plus half of your Social Security benefits. If that combined income exceeds $25,000 for a single filer, up 50% of your Social Security benefits become taxable. If it exceeds $34,000, up to 85% of your benefits are taxable. For married couples filing jointly, the thresholds are $32,000 and $44,000 respectively. Here is the brutal detail. Those thresholds, $25,000, $34,000, $32,000, $44,000, have not been adjusted for inflation since they were set in 1983 and 1993. Not once. In 1983, $25,000 was a solid middle-class income. Today, after decades of inflation, $25,000 is below the federal poverty line for a family, but the tax still kicks in at $25,000. So a retiree collecting modest Social Security benefits, combined with a small pension, a part-time job, or investment distributions can easily cross these thresholds and find their benefits taxed, even though they are by no objective measure wealthy. The Social Security Administration estimates that roughly 40% of Social Security recipients currently pay federal income tax on some portion of their benefits. That percentage has grown steadily over the decades as inflation has pushed more retirees above these static thresholds. Exactly the bracket creep dynamic described in the previous section, applied specifically to retirement income. This is not a tax on wealthy retirees with pensions and investment portfolios. This is a tax that increasingly catches solidly middle-class retirees who did everything right, saved, worked, paid into the system, and are now discovering that the money they thought was coming back to them has a tax attached. What you can do. The primary strategy for managing Social Security taxation is controlling what income you recognize in retirement and when. Roth IRA withdrawals do not count as income for the combined income calculation. They are completely excluded. This is one of the most powerful and underappreciated advantages of the Roth IRA for middle-class retirement planning. If a significant portion of your retirement savings is in Roth accounts, you have far more control over your combined income and can stay below the Social Security taxation thresholds. This is a planning decision that ideally starts decades before retirement. Another reason why the Roth IRA conversion strategy deserves serious attention for anyone in the 22% bracket or below. The fourth hidden tax mechanism is one that was originally designed for the wealthy, but is increasingly catching middle-class earners, particularly homeowners, investors, and anyone who has seen significant appreciation in assets over the past decade. It's called the Net Investment Income Tax, or NIIT. It was created by the Affordable Care Act in 2010 and took effect in 2013. The mechanics are straightforward. If your modified adjusted gross income exceeds $200,000 as a single filer, or $250,000 as a married couple filing jointly, you owe an additional 3.8% surtax on your net investment income, on top of whatever capital gains tax you already owe. Net investment income includes interest, dividends, capital gains from selling stocks or property, rental income, and passive business income. Now here is the detail that transforms this from a tax on the wealthy into a tax trap for the middle class. Those income thresholds: $200,000 for single filers, $250,000 for married couples, have not been adjusted for inflation since the law was written in 2010, not once in 13 years. And they remain frozen at those levels in 2026. Think about what that means in practice. Someone who was comfortably below the NIIT threshold in 2013 may have crossed it simply through normal salary growth and inflation over the past decade, without any meaningful increase in real wealth. But the trap becomes most acute in one specific scenario that is catching tens of thousands of middle-class Americans completely off guard. The home sale. Here's how it plays out. A married couple bought their home in 2012 for $320,000 in a suburban area. Home prices in their market have roughly doubled over the past decade. Not an unusual scenario for many parts of the United States. They sell in 2026 for $640,000, realizing a $320,000 gain. The tax code provides a capital gains exclusion for home sales, $250,000 for single filers, $500,000 for married couples filing jointly. So their taxable gain after exclusion is $320,000 minus $500,000, which in this example comes to zero. No capital gain tax. But here is where it gets complicated. If the gain exceeds the exclusion, if they sold for $700,000, netting a $380,000 gain after the $500,000 exclusion leaves them with a $380,000 minus $500,000. Wait, let me give you a more realistic example. A couple in a higher appreciation market buys for $280,000 in 2012 and sells for $900,000 in 2026. Their gain is $620,000. The exclusion covers $500,000. The remaining $120,000 is a taxable capital gain. And if their combined income, wages plus this capital gain, pushes their modified adjusted gross income above $250,000 for the year, the entire net investment income is also subject to the additional 3.8% NIIT. The number of taxpayers subject to the NIIT has grown from 3.1 million when the tax was introduced in 2013 to 7.3 million in recent years. According to Congressional Research Service data, that more than doubling of affected taxpayers happened not because more people became wealthy, but because the thresholds were frozen while wages, home values, and investment portfolios grew with inflation. Steady, ordinary economic growth has pushed ordinary middle-class earners into a tax designed for the wealthy. The same dynamic applies to long-term investors who have accumulated significant portfolio gains, rental property owners, and anyone receiving large one-time income events. A business sale, an inheritance involving appreciated assets, or a large severance package. A single high-income year can trip the NIIT, even for someone whose typical annual income is well below $200,000. The fifth hidden tax mechanism is the one people are most aware of in general, but least aware of in terms of its true total cost when stacked on top of everything else we've discussed. State and local taxes vary enormously across the United States, but for middle-class households in moderate to high-tax states, the combined burden is substantial. Let's build the full picture for a typical middle-class American household. Take a married couple in California with a combined income of $150,000. Federal income tax in their bracket roughly 22% marginal rate, with an effective rate closer to 15% after deductions, and the standard deduction of $32,200 for married filers in 2026. California state income tax at their income level, approximately 9.3% marginal rate, one of the highest state income tax rates in the country. FICA, 7.65% on their wages, employee side only. Property tax on their home. California's Proposition 13 caps it at 1% of assessed value, but even a modestly valued home generates thousands per year. Sales tax in California, 7.25% base rate, often 10% or higher in major cities, applied to most consumer purchases. When you add all of these up, federal income tax, state income tax, FICA, property tax, and sales tax, the effective combined tax rate for a middle-class household in a high-tax state can easily reach 35% to 45% of gross income, not the 22% bracket rate they mentally associate with their tax burden. 35 to 45% total across all tax mechanisms. And here's where the SALT deduction, state and local tax deduction, becomes relevant. Before 2017, Federal taxpayers could deduct their full state and local tax payments from their federal taxable income, providing meaningful relief for residents of high-tax states. The Tax Cuts and Jobs Act of 2017 capped that deduction at $10,000. The One Big Beautiful Bill Act, passed in July 2025, temporarily raised the SALT cap to $40,000 for households with income below $500,000, with the higher cap running through 2029 before scheduled reversion to $10,000 in 2030. This temporary increase to $40,000 is genuinely meaningful relief for middle-class households in high-tax states like California, New York, New Jersey, and Illinois. For a household paying $18,000 in state income taxes and $12,000 in property taxes, $30,000 in total SALT, the ability to deduct that full amount under the new cap can reduce federal taxable income significantly compared to the previous $10,000 cap. If you itemize and live in a high-tax state, 2026 through 2029 is the window to maximize that deduction. After 2029, the cap is currently scheduled to revert to $10,000 unless Congress acts again. For middle-class earners in lower-tax states, Texas, Florida, Nevada, Tennessee, which have no state income tax, the combined burden is substantially lower, often 20% to 28% of gross income when all taxes are included. This is one of the most financially significant but least discussed factors in location decisions for middle-class families. What you can do if you live in a high-tax state and itemize deductions. The SALT deduction cap increase to $40,000 for 2026 through 2029 is one of the most valuable tax provisions available to you right now. Make sure your tax preparer is maximizing it. Bundle state and local tax payments where possible to optimize the timing of your deductible amounts. And if you are self-employed or your income is flexible in terms of geography, remote work has made this more realistic for millions of Americans. A move to a no-income tax state represents one of the largest legal tax reductions available to a middle-class earner. The difference between California's 13.3% top marginal state rate and Texas's 0% is not a minor footnote. Over a career, it compounds into hundreds of thousands of dollars. Let's put all 5 mechanisms together and look at what the middle class is actually paying when you account for all of them simultaneously. Take a single American earner in 2026 with $90,000 in wages, living in a moderate tax state, no self-employment income, standard deductions. Here is the full tax picture. Federal income tax. At $90,000 in wages with the $1,100 standard deduction for single filers, taxable income is approximately $73,900. Federal tax on that income calculated across the brackets comes to roughly $12,500, an effective federal income tax rate of about 14%. FICA taxes, 7.65% of $90,000 in wages equals $6,885. Employee side only. The employer side match is another $60 or $85, which doesn't appear on the paycheck but represents the full cost of their labor. State income tax varies significantly. In a moderate state like Colorado with a flat 4.4% rate, that's roughly $3,960. Property tax, if they own a home, typically $3,000 to $6,000 per year depending on location. Sales tax, a 7% average sales tax rate on $35,000 in annual consumer spending equals roughly $2,450. Total. Federal income tax plus FICA plus state income tax plus property tax plus sales tax comes to approximately $29,000 to $32,000 on $90,000 in gross wages. That's an effective combined tax rate of 32% to 36% on $90,000. Not $500,000, not $1 million. $90,000, which is solidly middle class in 2026. And that's before we account for any NIIT exposure in years when investment gains occur. Before the Social Security benefit tax at retirement, before any years of bracket creep when raises barely outpace inflation. The point is not that taxes are theft or that government services have no value. The point is that most middle-class Americans have a fundamentally inaccurate understanding of their real effective tax rate, and that inaccurate understanding prevents them from making the planning decisions that could legally and significantly reduce it. Now let's talk about what you can actually do. Not tax evasion, not aggressive shelters. The standard, documented, IRS-acknowledged strategies that millions of Americans underutilize every single year. Strategy 1. Max every tax-advantaged account, first your 401k, your IRA, your HSA, These are the IRS giving you explicit permission to reduce your taxable income. In 2026, you can contribute up to $23,100 to a 401k if you're under 50 and $7,000 to an IRA. An HSA allows $4,300 for an individual and $8,550 for a family. Every dollar contributed to a traditional 401k or traditional IRA reduces your taxable income dollar for dollar, directly shrinking your federal income tax bill, potentially dropping you into a lower bracket, and reducing your magi for NIIT threshold purposes simultaneously. If you are not maximizing these accounts, you are paying more tax than the law requires. Strategy 2. Roth conversion in lower income years if you have money in a traditional IRA or 401k. Converting portions of it to a Roth in years when your income is lower. A year between jobs, early retirement, a year with large deductions, allows you to pay tax at a lower rate now and eliminate the tax entirely on future growth. This is also the primary strategy for managing the Social Security benefit tax in retirement and for building an income stream in retirement that doesn't push you above NIIT thresholds. Strategy 3. Tax loss harvesting. In a taxable brokerage account, when you hold investments that have declined in value, you can sell them to realize a loss, use that loss to offset capital gains elsewhere in your portfolio, and immediately reinvest in a similar but not identical fund to maintain your market exposure. This strategy, tax loss harvesting, can save the average middle-class investor hundreds to thousands of dollars per year in capital gains taxes. You're not avoiding gains permanently. You're deferring them and reducing your current year tax liability. Done consistently over a career, the compounding benefit is significant. Strategy 4. Time large capital gains carefully. If you are planning to sell a home, sell appreciated stock, or realize any large one-time gain, think carefully about what year you do it in. If you can time the sale to a year when your other income is lower, a gap year, a career transition, early retirement before Social Security begins, you may pay a lower capital gains rate and stay below the NIIT threshold. This kind of proactive timing can save $5,000 to $20,000 or more on a single transaction. It requires thinking a year or two ahead, but the return on that planning time is extraordinary. Strategy 5. Work with a CPA, not just tax software. The 5 tax mechanisms we walked through today: payroll taxes, inflation bracket dynamics, Social Security benefit taxation, the NIIT, and state and local tax management, interact with each other in ways that require personalized analysis. Tax software gets you to compliance. A qualified CPA who specializes in tax planning, not just preparation, gets you to optimization. The difference for a middle-class household taking full advantage of legal strategies versus one that just files and pays can easily be $3,000 to $8,000 per year in reduced tax liability. Over a career, that difference compounds into hundreds of thousands of dollars. A CPA who saves you $5,000 per year and charges $1,000 is the highest return professional relationship most middle-class Americans can have. Let's close with the complete picture in under 2 minutes. The middle class in 2026 is not paying their stated federal bracket rate. They are paying a layered, compounding collection of tax mechanisms that together can push the effective total tax rate on a $90,000 income to 32% to 36% or higher. Those mechanisms are FICA payroll taxes, 7.65% on every dollar of wages, 15.3% for the self-employed, structured in a way that hits middle-class wage earners harder than the wealthy. Inflation and bracket creep, the silent erosion of purchasing power, taxing nominal gains that don't represent real increases in wealth. Social Security benefit taxation, a double tax on benefits you paid into with after-tax dollars, hitting retirees through thresholds that haven't been adjusted since the Reagan administration. The net investment income tax, originally aimed at the wealthy, now catching middle-class homeowners, investors, and anyone who has a single high-income year through thresholds frozen since 2013. And state and local taxes, a burden that varies enormously by geography but compounds severely with the federal load for residents of high-tax states. And the strategies to fight back. Maximize every tax-advantaged account every year. Use Roth conversions in lower income years. Harvest investment losses systematically. Time large capital gains events deliberately. And work with a real tax planner, not just a tax filer. Here is your one action from this video. Calculate your actual effective tax rate, not your federal bracket rate, your actual rate. Add up what you paid in federal income tax, FICA, state income tax, property tax, and a rough estimate of sales taxes, and divide that total by your gross income. That real number is what you're actually working with. Write it down. Share it in the comments below. I want to see how many people are surprised by their real number. Subscribe for weekly videos that give you the real mechanics of personal finance, not simplified talking points. See you in the next one.